Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It is Monday, February 22nd, 2021, and I'm pre-recording this Trading Places Live for Tuesday, February 23rd. It was a rough day on Monday. Currently checking on futures. I'm going to give you the latest that I see here. Of course, it is Monday evening, so things will change. But currently, we do see futures up a little bit for Tuesday. Dow Jones futures up 62, the S&P 500 up 8.5, and the Nasdaq hit pretty hard on Monday, and the Nasdaq looking up right now. Futures up 23 3/4. So, we'll see how things carry over into Tuesday. Action was pretty bearish on Monday, but it is right around options expiration day for February. That was last Friday, and so it's not unusual to see some time just beyond options expiration day. It's not unusual to see a little bit of bearishness carry into the following week. So I'm not certainly not concerned about the long-term picture. Short term, we may have a little bit more weakness to go. We'll see how things shake out on Tuesday. As far as our agenda for today, we've got, of course, daily market recap. Talking technically, I'm going to dig a little bit into energy for you. Energy's had quite a run to the upside, and I think energy looks as good as it's looked in a long time. But we've got, when you go down for months and months and months, and on a relative basis, literally for years, it is, it's a stair step kind of a thing back to the upside. So we're going to talk about some levels to watch in the Talking Technically segment. Then go through the earnings spotlight with you. Got a couple mailbag questions, and then we'll wrap up with the 3 you must see. So before we get into any of that, though, let me take you over to earningsbeats.com, where we do offer a free Earnings Beats Digest newsletter. Just requires a name, email address. Hit that subscribe button. We'll begin sending you out the Earnings Beats Digest on Wednesday morning. It is published Mondays, Wednesdays, and Fridays. Excuse me. And normally it's out before the market opens. So you can expect sometime within an hour of the market open usually is when it goes out. There is no credit card required, and you can unsubscribe at any time. If you'd like to join our service, love to have you. We do have a 30-day no-cost trial. So you hit the Join Today button sign, you can sign up. There is an initial charge of $7, but we refund that to you within a week or so that for the first 30 days, literally it's no cost, net zero. You can check it out. Portfolios have done extremely well. This is through last Friday, which was the end of our quarter. We run our quarters beginning February 19th, May 19th, August 19th, and November 19th. So we did just finish up the November 19th quarter that ended on February 19th. And you can see the results there. Quarterly numbers were off the charts, literally. And since inception numbers, for the most part, well above and well ahead of the S&P 500 over the same period. We also have an ETF portfolio down here that we update normally on a daily basis as well. And the model ETF portfolio that we have has been outperforming. You can see we just started it on October 19th, and already through last Friday anyway, we were up more than 10 percentage points over the S&P 500. So there is a method to our madness for sure. All right, let's jump into the recap for Monday. It was an ugly day if you were looking at stocks on the NASDAQ, especially stocks that have been doing pretty well. High growers, the ones that had been getting rewarded with some really good earnings numbers and so forth. I think now maybe a little bit of that's old news. Money's rotating over, and it doesn't help that options expiration was Friday. I talk about this every month, but when you have big runs into option expiration week, a lot of times you'll see these reversals. And the reason it can carry over into the following week is that many of these options that are in the money are exercised. And so you've got market makers who are no longer, on the sell side of the call, for instance. But now if that call has been exercised, now market makers are on the short side of the stock, period. And so you can see this what I refer to as like an options expiration hangover into the early part of the following week. And I think that's what we saw today on the NASDAQ. I'm personally not concerned longer term. Short term, this could continue another couple days. We'll have to watch it. We broke down below that 20-day moving average. I'd really like to see us get back up through that 20. All the other major indices really had no problems with the 20-day moving average. The S&P 500 was close, but we did manage to close a couple points above. Really, it was just the NASDAQ, and many of the high flyers do reside on the NASDAQ. Mid cap, small cap. Actually, small cap was up today on Monday. Pretty good action considering that only the Dow, that was the only other index that was up, and that was fractionally. Gave back quite a few gains. I mean, had some gains earlier in the day, but it did pull back. S&P 500 ended up losing 30 for the day, 0.75%. But there's your loser, the NASDAQ, down 341 points, or almost 2.5%. So it was a rough day for NASDAQ shares for sure. The energy group leading to the upside, crude oil, had another big day, and as a result, energy was up almost 3.5%. Financials doing well. We got that 10-year Treasury yield continuing to move up. We'll look at that in just a minute, but that certainly is spurring on a lot of buying in the financial area. Real estate bouncing off its 20-day moving average, up a little more than 0.5%. The two laggards, and when you see the NASDAQ performing as poorly as it is, or as it did, technology and discretionary, you're generally going to find probably not doing particularly well, and they didn't. They were both down. They both closed below their 20-day moving average. I would probably, I mean, the 50-day obviously is a level to watch as well, but I would be paying attention really to the recent lows. So I do think there's a potential for another couple percent to the downside in the short term. Long term, like I said, I'm not overly concerned, and I do expect that we will be back up at all-time highs. Moving on to the 10-year Treasury yield, I will say that on Tuesday, we have the December Case-Shiller Home Price Index coming out. The expectation there is that it rose by 0.9%. Keep in mind, we are talking about December. We're almost into March. So this is, looking in the rearview mirror quite a bit. I really honestly don't know that the market cares too much about this, but anyway, the expectation is for 0.9% for the month of December. November was a rise of 1.4%. So we are looking for that growth to slow down a bit. Also, the December FHFA House Price Index coming out, and similar story. November was up 1%, and December is expected to be up, but up less. So it's expected to be up 0.8%. And then finally, February consumer confidence is due out. January was 89.3. We're looking for February to jump up to 89.7. Looking at the 10-year Treasury yield, I mean, this is kind of what I've been calling for. I mean, this was one of the things that I pointed out that would be a catalyst to driving equity prices higher. The shift from treasuries, from the bond market over to stocks. We had all the earnings explosion, especially in some of the high octane, aggressive sectors, and those areas carried the market to the upside. Now we're starting to see fund managers and portfolio managers looking at what's taking place in the stock market and saying, hey, I don't really like this 1% yield or 1.3% yield. I would like to maybe, do a little bit better than that and move some of this money parked in treasuries into the stock market. And so when you see the yield rising like this, it's an indication that treasuries are being sold. That's what sends the yields higher, and that those proceeds are being used to move into the stock market. So this all kind of fits together. We are seeing some of the groups that struggled during the pandemic, when yields were dropping and so forth. Banks, life insurance company, many of the areas within the financials did not do well. Now that we're back and moving higher again on the yield, we're seeing financials participate, not just participate, but lead. I don't think that they're going to be big winners for 2021, but I absolutely expect that they're going to move higher. And I think that they'll keep pace with the S&P 500. So you'll be able to find some leaders in the financial area that can bolster your portfolio. Energy is a different story. Let's talk about energy a little bit. So in talking technically today, I want to focus on this group. This is a 5-year weekly chart. Now, we're trending above the 20-week moving average, which is above the 50, and they're all turning higher. The PPO looks good. There's, in the very near term, I love what's going on here with energy. And I said that recently when we made the breakout above the $45 area. I just felt like this is the best that energy has looked. I mean, if you look at this was more of a dead cat bounce. We pulled back, didn't quite get to the lows, started moving back up again, but it's taken a while for all of that selling that we saw back in March to kind of fade away and for the group to really start to pick things back up again. And I think it's also an indication that the global markets are expecting a lot of improvement, economic improvement in 2021 and beyond. There's no other reason why crude oil prices would be jumping the way they are if it's not for anticipated. You either need demand or you need anticipated demand, anticipated strength in the economy. One or the other is where you get the crude oil prices rising the way that they've been rising. So that is all good news. And I do think that energy will continue to move higher. I'm a little concerned because I think the dollar will eventually have a pretty good year in 2021. Maybe I'm wrong, but for now, I think all my signs are pointing to a strong dollar later this year. And if that's the case, then I think energy on a relative basis to the S&P 500 could lag. It could I think it's going to go up, but it could lag. And where I really see some short-term issues and something we can talk about right now, there was a gap from here. This is when we started seeing that huge selling back at the end of February. We were at about $50, $51 on the XLE when in 4 weeks we went all the way down to 21 and change. That was a 60% haircut in 4 weeks. Now the overall market, the S&P went down about 34, 35%. The XLE went down 60%. It was the worst area of the market. So yes, we've come back quite a bit, but we've come back from the ashes of the worst sector. So there's work to be done here. A couple of good things, couple of things we're going to have to work on. So you can see here, that was kind of a candle body low on the weekly chart back in December 2018. It's also pretty close to where this gap, if you look at this gap here, that was the bottom of the gap. The top's up at 51, the bottom's around 48, 48 and a half. And today's high was 48, 47. So I think we're moving into this zone. Now, the other thing that I think is important technically on this chart that maybe you don't see, or let's go ahead and just pull up this trend line right here. Because if you connect those highs, notice that those highs come in right into this zone as well. So I'm looking at some pretty significant overhead congestion here at about 48.5, 49, up to maybe 51. And that's where we are. And we've had a big run. So a pullback from this level would not be out of the question. And in fact, might spook a lot of folks that are jumping in and chasing this rally to the upside. Now, the one piece of really good news, though, is that we have cleared the June high that we saw right there. See this reaction high in June? That was that $45 level. See how we got up to 45, hit that resistance, failed. Where do we go? Almost back to that 20-week. So now we break above both of these and get up into this zone. If we pull back, I think we could maybe pull back to 45, maybe even a little bit below as this rising 20-week moving average moves higher. So I think the rising 20-week moving average is going to provide a support. I don't know if we get all the way down to it. I think we could, but probably I see this moving up into the 50, 51 range. And then perhaps we get a 10% pullback to around 45. And by that time, the 20 may be coming up from underneath. That would be a great support area at that point, and likely a very, very solid entry point if you're not already into any energy stocks and want to get into energy. I look for outperforming areas. And again, for me, I think the dollar goes higher later this year. So I think energy is getting a nice boost. You're getting a lot of technical buyers jumping in because of what's taking place on the charts. Of course, crude oil driving a lot of folks into oil as well, into energy. But I think after this run is over, I think the relative strength is likely to wane again. And so for me, I'll be looking in other areas. But if you're looking to maybe jump into a piece of energy, I think down the road, you're going to get a pullback and get a really nice opportunity. All right, I want to keep moving on to energy. I want to look at some of these other areas because energy is only as good as the overall group. And when you start looking at the industry groups, you've got to pay attention to key resistance levels there. So let's take a look. For instance, there is resistance, there's support. Here's the resistance area. So pipelines, you got maybe another, we're at 513. I could see close to 550. So you're talking about maybe another 7% to the upside in pipelines. Not bad. And eventually we go higher than that. I'm just talking short term. I would expect if we get to that level, close to 550, I would imagine we'll pull back. All right, so we got a couple other industry groups here to take a look at. The oil equipment and services group got another, got a little bit of room here as well, maybe even a little bit more room on a percentage basis. We did take out the June high. This is an area where we broke down from in February, right around 200. We're at 174. 26 from here would be about another 15%. So that's possible. I don't know that we go there right away, but it's certainly a possibility. The next group within the energy space is integrated oil and gas. Now, we haven't taken out the the June high here. So we're going to have, usually you don't go through on the first test, but right around 415, it looks like we're going to have some work to do trying to get through that level. If we do, then I think, potentially we could have a much bigger move in integrated oil, but I would respect that June high around 415. So that's about 3% from where we are right now. And then the last group I wanted to bring up is the exploration and production area. And this one is almost right at resistance right now in terms of where we broke down from. So you can see the lows, the low here, then the big breakdown on heavy volume. Now we're coming back up 525-ish. We got as high as 528 today. And I would say 525 on a closing basis. So if we fail, if we go up this week, get above, clearly above that 525 level, maybe even above today's high, 528. Say we get up to 535 and reverse, we leave a long tail above this resistance level. That would be a warning sign for me in the short term for this group. Now, again, as long as that rising 20-week moving average keeps holding, then I believe we go higher and continue to push higher. And I think all areas of the market are going higher. So even though I'm not a huge fan of energy, I believe energy is going higher. I just don't think it's going to be the leading sector once this run is over. It's leading right now, no doubt about it. It's playing some catch up. But I think once this run's over, I would be a little careful on energy in the near term. All right, let's keep moving on. I'm going to go through some earnings reports with you in the earnings spotlight. So the first stock that reported after the close today that I saw was Cadence Design Systems, pretty large software company. You can see as we've been moving up, it just seems to be a little bit more labored. Volume was a little less on the last push higher, AD line rolling over, and you can see pretty poor action on Monday. However, after the bell, let me give you an update here. After the bell, we're up almost 4.3%, almost $6, 138.90. So $5.74. We lost $6.50 during the day. So we're basically getting back what we lost throughout the day on Monday, or most of it. But Cadence Design overall is pretty good software stock. They did come out with some great numbers, 83 cents versus 75 cents. So pretty nice action there. And another software stock that came out and performed pretty well after hours was Five9. This was actually one of our stocks in our portfolio from last quarter. We didn't keep it in the portfolio this quarter, fortunately, based on what happened today, but it did rally back pretty nicely after hours. So let's pull that up, see where we are. So we're up 9%, $15, $182. Now, we were down $23 during the day, so we're getting back about 2/3 of that. Not where we were. So if it were me after the gap up and seeing some of the deterioration on heavy volume, I don't know, I might be willing to take my money and run on the opening gap. We'll see what happens tomorrow. But I just think short term, based on what happened to the NASDAQ on Monday, it just seems like some rotation. That normally takes more than a day. I would expect maybe another day or two of relatively weak action on the NASDAQ. We'll see. Longer term, I remain very bullish, the NASDAQ and these software stocks. There aren't too many companies that can grow their earnings as rapidly as software. Now, one of the problems that the market is running into, or that we're running into, is that when interest rates are moving up, interest rates at 1.37%, not a problem. That is not a problem. It's not going to be a problem for a long time. However, many of these high growth companies are being valued based on very, very low interest rates. So any kind of movement to the upside does impact their valuations to some degree. So I can understand as interest rates move up how money, a lot of folks want to move out of some of the high flying stocks and into areas that haven't performed as well. And so, I talked about that a little bit at the draft that we had on Sunday night, where we gave out our 40 stocks for each of our 4 portfolios. And we started making some changes in our portfolios as a result. We have a number of smaller cap companies that we didn't have previously, certainly more of those. And then we also moved more into stocks that didn't do as well during the pandemic that are starting to come to life. So we shifted as well. Not a lot, but we did shift a little bit. I still believe these growth stocks will do well as we go forward. Another earnings report that came out. Let's take a look at PANW. And by the way, 5.9, they came out with earnings of 34 cents. Market was expecting 23 cents. So these, when you're beating earnings like that, and then you start, expanding your growth multiple going forward, that has a big impact on your valuation. So I do think even if we pull back on these software companies, I think we're going to see a continuing rally down the road. Palo Alto Networks, this is in the telecom equipment area. They beat $1.55 versus $1.44. Last time I looked, though, there really wasn't much of a reaction after hours, down 1.6%. But it was down 3% earlier in the day. So take those two combined, and you're talking about 5% of the market cap gone in 24 hours. A couple of earnings that had some nice reactions, or big reactions, I should say. One was an internet stock, EverQuote. And EverQuote been getting hit pretty hard here, but the stock did beat on the bottom line. They were expecting a loss of 14 cents. They had a loss of 13 cents. So not a huge beat, but it was a beat. And after hours, up 13%. So it lost $3.62 during the day, but it's rebounded $5.97 after the close. So 50-50 would take it right back up here. Still not breaking out, but probably what we're going to see is just further consolidation here on the stock. That's what I would expect. One last thing I'll mention about the earnings that came out. There were 4 companies that I saw. 4 companies that I saw out of 24. 4 of them missed earnings. All 4 of them were in the energy space. So that's another reason why, and I realize that that's last quarter and market looks ahead and crude oil prices are moving up. So I do think that the environment will be better, but still they missed. It doesn't matter. I'm not overly concerned whether they lost money, because obviously it was a very difficult period for energy companies, but they didn't even achieve what they said they were going to do. And that, I do have a little problem with that. And that's one of the reasons why we don't have many, energy stocks on our strong earnings chart list, because many of them are missing their earnings numbers. So it's, until they begin to get into a stronger environment where they can actually beat some of these estimates, I think it's going to be a little problem. All right, let's move on. I will also mention one last thing. Home Depot reports on Tuesday morning, as does Crocs. Crocs has been a pretty nice performer in the footwear area. So those are a couple to watch in the morning. All right, let's move on to Mailbag. I had a question from a member, and the question was, how do I find the 10 best stocks in a strong industry group? Well, I could go in a lot of different directions here because I don't know from 10 best, are you looking for the 10 highest market cap? Are you looking for the 10 best that have performed the last 30 days? Are you looking for the 10 best over the last 20 years? There's a lot of different ways to approach that. But I'm going to just show you, for instance, the semiconductor group. And, because this has been a pretty strong area of the market. And so if I just pull up this daily 1-year chart here, you can see we've been trending higher. Now, there's a lot of different ways to go about this. For me, what I would do is I go to our strong earnings chart list. And from there, I do view all and go into the summary, and I type into the search box. Well, first, let's sort it by scooter, and then type semiconductors. And you can see all of the semiconductors that are on our strong earnings chart list in scooter order. Now you can see it was a rough day for semiconductor stocks. Almost every one, all but one on our strong earnings chart list was down. Amcor was the only one that went up today. And the ones that had the highest scooter scores tended to be the ones that got hit the hardest. I think a lot of that had to do with options. But anyway, there's a lot of profit taking being had, money rotating into other areas. So that's one way to look at it. I'll give you one other real quick. And that would be to go into the member tools over here and go down to scooter reports. And under large caps, I would do the same thing. Type in semiconductors in this search box, and it'll give you the list of, your various semiconductor stocks based on their relative strength rating. You can go to mid caps, do the same thing there, and then small caps. So there's just a couple of ways that maybe you could zero in to try and find some of the better stocks. All right, let's move on to the 3 you must see. And I'm going to go over 3 breakouts today that I thought were pretty impressive. We'll start with Jones Lang LaSalle. This is in the real estate area. And you can see the overall group has just kind of been okay. But JLL has actually been moving up relative to its peers. And this bump today, look at that nice candle. Volume picked up. AD line turns back up again. I think overall this one looks pretty good, and I like stocks when they make the breakout. Notice the last failed breakout, that long tail, and then it pulled back to the 50-day. There was no failing on this one. We got the confirmed breakout, which is nice. The second stock I have for you, this is a company just reported very solid earnings, Korn Ferry, KFY. This is in the business training area, and you can see business training really beginning to strengthen. Look at the relative strength. Korn Ferry is one of the leaders. Great volume, breakout, AD line looks great. Keep this one on your radar. A pullback would be buyable. And then the last one I have for you is CTVA, moving into the materials area. And CTVA, nice little cup. See this uptrend? Cup, handle, breakout, volume picking up. AD line strong. And look at the relative strength again. Now the group, not so great, but the stock relative to the S&P and to its peers, very strong. So I think those 3 look good. And that is it for today. I want to thank everybody for stopping by. Next Trading Places Live will be over at Earnings Beats on Wednesday morning at 9 a.m. Hopefully see you there. Happy trading.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.